So 5 trading days. That's basically all it took for Google to fill its gap after earnings the other day, 5 days ago. I entered trades because I saw that the RSI was oversold. The reaction looked way overdone, and both of our Google positions are now profitable. Um, but I haven't closed anything. I haven't trimmed them. And I haven't rolled anything yet. So that leads me to make another decision. Do I hold Google? Do I look at Amazon after its enormous earnings move? Do I wait for a Microsoft pullback? Or could there eventually be room for both companies in my practical income portfolio? That's what we're here going over today in this video. Now, before we go any further, I am not a financial advisor, and nothing in this video should be considered financial advice or a recommendation to buy or sell any security. I'm simply showing you what I'm doing with my own money and explaining the thought process behind my decisions. Options involve substantial risk and are not appropriate for every investor. Always do your own research and always make sure you understand the risk before entering any trade. Now, let's start with the official portfolio update. As of last confirmed check, Thursday, 1 p.m., the Google Sleeps positions that were in were up 16.77% apiece, and the Google put credit spreads were up 45.14% each. Now, both of these figures are unrealized returns. I have not added to either position. I haven't trimmed anything. I didn't roll anything, and I didn't close anything. I am holding both positions exactly as they were. After that update, Google moved another approximately 1.36% higher in extended hours trading. That means the option returns are going to be higher now, but I'm not going to guess at what the option price um, or manufacture a better number. These were actual numbers at 1 o'clock on Thursday. Those percentages on the screen are what I personally am confirming. The more important development happened on the chart. Google has now recovered its entire initial earnings gap. The stock returned to approximately where it began post earnings drop, and it completed that recovery in roughly 5 trading days. That goes directly back to why I entered these trades to begin with. So I entered Google on July 24th because the stock had pretty severe reaction to what I considered solid earnings. Uh, my On my chart, RSI had moved into an oversold area right around 30. The stock was also around its 4-month value area low and near the 200-day moving average. So we had several things confirming this confluence. At the same time, a monster company, solid underlying business results, an oversold technical condition, and a large post earnings reaction, in my opinion, looked way overdone. None of these things guaranteed that Google was going to bounce. Nothing in the market is guaranteed, but it created a setup where I believe the possible reward justified the risk I was taking, right? So the earnings drop also created a tremendous amount of liquidity. Now, my interpretation was that this could give the larger buyers an opportunity to build their positions at lower prices. That's kind of what happens when you get these liquidity sweeps. Now, I want to be careful with that statement. So, relative volume during this recovery it wasn't extraordinary, right? The volume was around average during those 4 days. So I can't really prove that institutions came flooding into Google necessarily based on that volume profile, but that's just simply my interpretation of what I saw in the price action and the opportunity created by the earnings reaction. So, whether the interpretation is completely right or wrong, the price has now recovered that gap, and that was one of my original upside objectives. All right, so where do we go from here? For the moment, I continue holding. The next area on my chart is around 344. After that, the more important decision area for me is going to be right around that 350 area, near the point of control that I'm watching. If Google reaches that area, I may begin to trim part of my position. Maybe, you know, sell one of my leaps, or maybe close out a couple of my put credit spreads. I still see the possibility of longer term move towards approximately 373. And the leaps positions were designed to give me that larger move and time to develop, right? So the put credit spreads are a little different. They're shorter term, defined risk portions of my trade, and they're already approaching my normal 50% profit management area. That means the spreads could require a decision before the leaps do. In fact, I completely anticipate that's going to happen. With this last bit of increase after earning or after the market closed today, I feel that my first target of 50% on my put credit spreads will be reached, and I probably will more than likely trim a couple of my put credit spreads. Being bullish on the same company doesn't mean every position on that company should be managed exactly the same way. For now, I made no changes. The thesis remains intact, um, and I'm holding uh, that that decision true, right? So doing nothing doesn't mean I forgot about the trade. Sometimes doing nothing is the most deliberate decision you can make. Now that brings us to the realized return, the return scoreboard. Even though both of our Google positions are profitable, our realized return for the week remains 0%. Our realized return since launching the portfolio is also 0% because we haven't closed anything out yet. This was our first official trade in this series. So an unrealized gain is encouraging, but it's not a realized income. I'm not putting open profits on the scoreboard and pretending that that we've already earned them. When we trim or close a position, of the realized percentage will be recorded. Until that happens, the scoreboard stays at zero. That's just how we're doing it. I want to keep this portfolio as honest as possible. Whenever you come back to it, you're going to be able to see, the positions that we're in and exactly what I closed out and why. Hopefully, this is something that people can watch and perhaps learn something if this helps. All right, now let's look at what might come next. Amazon and Microsoft both delivered huge post earning results. Their moves were massive, and I'm interested in both of these companies. But being interested does not mean I'm going to chase either stock. Let's start with Amazon. Amazon reported an excellent operating quarter. Revenue increased 20% to over a little over 200 billion. Operating income grew 43%, while AWS revenue increased 37%, which is the fastest growth in 18 quarters, by the way. Amazon also reported earnings per share at 575. And hold on, that number needs a little bit of context. The quarter included approximately 53.4 billion in non-operating income. That's primarily related to that Amazon investment in Anthropic, similar to what Google did, by the way. Now that means that huge EPS result was not entirely produced by Amazon's normal operating business, right? So even after separating that investment gain, however, the underlying quarter was still really strong. Okay. I did buy Amazon shares before earnings, but I had not publicly introduced that position as part of this portfolio, so I'm not going to use it in our discussion. Um, I'm not gonna I'm not gonna be backdating it or pretend it was already part of a public journey. If Amazon becomes an official portfolio position from this point forward, I will introduce and track it honestly from that point. So following the earnings move, the area I'm interested watching is approximately 250. I'm looking for just a small pullback. That doesn't mean I automatically buy at 250. I want to see confirmation that if it does pull back to 250, that area holds and reclaims. Um, so this 250 is a very possible entry for me. Now, if it blows straight through that level, I wait and I'll see if it keeps running without giving me a sensible entry. I'm not going to chase this. So that's what I'm doing with regards to Amazon. Microsoft, on the other hand, is another company I'm watching. Microsoft reported quarterly revenue of approximately $90 billion, while Azure and other cloud services revenues increased 43%. Now, the stock responded with a move of more than 15%, reaching 458 during this session. Now, that's an incredible move for a company of this size, you know. But once again, a great earnings report doesn't automatically create a great entry. So on my chart, Microsoft has uh, what could be viewed as an inverse head and shoulders pattern, or even more simply, just a large W bottom. Uh, a, the pullback area I'm looking at is approximately 430 to 433. If Microsoft pulls back, holds that area, and gives me confirmation, I may become interested. But I'm not going to chase this move, especially after it moved more than 15%. Um, Regardless of how much I like this company. So the pullback to 430 with confirmation on an upside move, I'm looking to potentially get into this. So that brings us to Tuesday's decision: Amazon versus Microsoft. Which company offers better potential here? Um, which one offers better risk to reward setup here? Would shares, leaps, or defined risk option positions make the most sense? Now, there's a possible and a very legitimate case for eventually owning both. Um, I don't have to answer that right now, but there's definitely a possibility. We're going to examine these businesses. I want to watch the price action and make the decision based on the setups the market actually gives us. Google is showing us how to manage the existing winners without automatically selling too early. Amazon and Microsoft are showing us why an outstanding company and an outstanding earnings report can still become a poor trade if we chase the wrong entry. Sometimes the best decision is to hold, sometimes the best decision is to wait, and sometimes the market finally gives you the price that you're looking for. Have a plan and stick to it. Now, if either of these companies um, gives us what we want before Tuesday, there potentially will be an entry on these positions before Tuesday. If that happens, I'll either do a very quick supplemental video, or I will let this particular section of this video uh, per, act as the preemptive um, uh, entry into these positions. So keep in mind, I'm going to be looking for either shares, leaps, and or some kind of more than likely a put credit spread, or possibly even cash secured puts here. I don't think a buy right is going to be in the cards at this point, because I think that we're going to have a much bigger upside move over time. And there could be a combination of all of these strategies, just like we were in it with Google. The long-term strategies for long-term growth, and shorter term premium capture for shorter term trades. That's what we're going to be looking at for these companies moving forward. If you want to follow this portfolio from beginning to end, the winning trades, the losing trades, and every decision in between, please subscribe to the channel and let me know in the comments. If you had to choose today, would you rather own Amazon or Microsoft, or maybe both? Thanks for watching Practical Income Investing, and we'll see you Tuesday for the update on these positions. And over the weekend, the educational series will continue with another video. So stay tuned. Thanks for watching.